Is Lululemon stock setting up for a major rebound, or is Wall Street right to stay cautious? The company just posted double-digit revenue growth, expanding margins, and even launched a $1.6 billion stock buyback. This is a move that screams confidence. Meanwhile, its peer competitor Nike is trading at a much higher valuation multiples, despite slowing profitability and rising margin pressure. So why is Lululemon stock still down more than 35% from its highs? Is this a hidden opportunity or a value trap? Hi, this is Chris. Welcome to my channel. In today's video, we are diving deep into Lululemon's fundamentals, valuation, and technicals, and comparing it side by side with Nike using real multiple data from AlphaStock AI. We'll break down earnings, performance, profit margins, intrinsic values, and show you the price action that could reveal the next move. If you are wondering whether Lululemon is ready to lead again or if Nike is a safer bet in 2025. So this is the video you need to watch. Let's get into it. Now, let's first look at their recent earning calls and see what sentiment we can get using the AI tool from AlphaStock AI. This is a high-level summary. Revenue growth, Q4 revenue rose 13% year-to-year to $3.6 billion, with full-year 2024 revenue at $10.6 billion. That is up 8% excluding the 53rd week. This is a strong top-line growth number, especially in a retail landscape. There are many peers struggling with flat or even declining sales. And the adjustment for the extra week showed Lululemon's disciplined reporting. The double-digit Q4 growth highlights robust holiday season demand. Profitability, the operating margin improved by 40 basis points to 28.9% in Q4, with EPS increasing 16% year-to-year. This margin expansion is impressive, especially during the economic context of inflation. It signals Lulu's cost control and pricing power. The 16% EPS growth, which even outpaces the revenue growth, suggests the improved operational leverage. This ability that Lululemon is able to preserve the profitability while expanding internationally is a good sign for long-term investors. Stock buyback. Lulu repurchased $1.6 billion in 2024. This is quite confidence for their long-term growth. This repurchase is not small at all. It represents Lulu's substantial portion of free cash flow. Buybacks, typically indicate that the management believes the stock is undervalued and it can enhance the shareholders' value by reducing the share count, which also boosts their EPS. But generally, investors should ensure this repurchase isn't coming at the expense of necessary growth investments, which is obviously not the case for Lululemon. Now let's see what are the key insights from the earnings. Product innovation, a strong pipeline with new launches like Glow Up, Daydrift, blah blah, indicating the continued focus on innovation and the guest engagement. As you know, for most customers who have used Lululemon's product know that innovation is a key and a core differentiator for Lululemon. These launches show they are not just chasing trends, but also creating them. Brand awareness efforts to increase brand awareness globally, particularly in those under-penetrated markets like France, Germany, and Japan. U.S. market modest growth expected in 2025 due to the macroeconomic challenges, but the newness and innovation are driving positive guest response. This is a realistic stance. The U.S. consumer remains pressured by inflation and interest rates. However, Lulu's strong brand loyalty and innovation help mitigate some of that softness. The key will be maintaining full price sell-through rates without relying on heavy promotions. International expansion. There are plans to open 40 to 45 new stores, focusing on international markets, especially China, with a 10% square footage growth target. Now let's check sentiment and tone from this earning. It's generally the positive sentiment. Management should express their confidence in product innovation and the brand strategies despite the macroeconomic headwinds. This confidence is well supported by their financial performance and a strong customer response. It's a vote of assurance to shareholders that Lululemon believes in its long term roadmap, not just quarter to quarter wins. However, some cautious optimism remains. Investors should acknowledge dynamic macro environment, particularly in the US, but remains focused on the controllable factors. This shows mature management rather than trying to sugarcoat macro risk. They are doubling down on what they can control: innovation, customer experience, and global expansion. That's exactly what the long uh, that's exactly what the long-term investor want to see: resilience through uncertainty. Now let's check the investment recommendation from the AI Insights in this earning call. It's a buy because of strong product pipeline, international expansion, and the brand building efforts position Lulu for long-term growth. If you're a long-term investor, this setup is compelling. Lulu's durable competitive advantage lies in its brand power, loyal customer base, and ability to command premium pricing. These are rare in retail landscape. They compound over time. So what you should monitor is keep your eye on the US market performance and macroeconomic impacts, particularly consumer spending trends. The US is still their core revenue base, and any consumer pullback could weigh on short-term performance. There are still some areas of concerns. FX headwinds and tariffs could pressure margins. Cautious consumer behavior in the US may affect short-term growth. FX is an underappreciated risk, especially with Lulu's expanding globally. A stronger US dollar hurts Lulu's revenue from abroad. Meanwhile, the escalating tension of tariffs with China, this could significantly pressure the gross margin. In conclusion, Lululemon's strategic focus on innovation and the global expansion, coupled with strong financial performance, makes it a compelling investment. However, investors should remain vigilant about the potential macroeconomic challenges impacting the US market. So the story here is balance. Strong fundamentals, smart leadership, and a global growth balanced against a tough consumer backdrop and a geopolitical risk. For now, Lululemon remains one of the best in class names in this sector. Now let's look at Nike's recent earning call published on March 20th, 2025. This is a high-level summary. Nike reported a 9% decline in revenue and a 7% on currency-neutral basis. The currency-neutral means the adjusted number after removing currency exchange rate. This decline is a sizable top-line contraction, especially for a company like Nike's scale. The fact that even the currency neutral number shows 7% drop means it's not just a FX at play. This reflects a core business softness. It's a signal that Nike is facing meaningful headwinds in demand, especially in some key categories. The gross margin fell by 330 basis points to 41.5%. This is a big margin compression, and it tells us that Nike is either discounting heavily, facing higher input costs, or both. For a brand that is historically leans on premium pricing, this margin drop indicates the rising pressure to maintain their volumes. The current earning per share stood at 54 cents. This EPS came in line with lowered expectations, but is a sharp drop compared with the prior quarters. The company is executing its win now strategy, focusing on igniting culture, brand distinction, and product portfolio acceleration. This win now strategy signals the urgency, but also implies the recovery efforts. The pivot toward culture and product relevance is essential, but the question is, can Nike deliver quickly enough to offset the structural declines? The key takeaway here is the revenue decline. Nike experienced a significant revenue drop attributed to the declines in classic footwear franchises and the challenges in China. This is a big worry for Nike. They're old popular brands that used to make a lot of money for them, but now less people and fewer people want them. Customers are starting to like other styles or brands. Especially in China, where Nike used to grow fast, things are getting harder. Local brands are competing more, and there are also some problems between countries, making it tougher to sell. Product innovation. Nike is focusing on new product launches, blah, blah. This is good news. Nike is going back to what it's really good at, making shoes and gear for sports and training. These areas have a lot of competition, but they can grow a lot over time, especially for young people. Marketplace strategy. The company is repositioning its digital and wholesale channels to focus on full price sales and reduce promotional activities. This is a smart change in Nike's strategy. They used too many discounts before, which seriously hurt Nike's brand name. Now they are trying to sell more without a big discounts. This could help the profit, but they have to do it really well, or it could hurt their sales even more. A geographic focus. Nike is prioritizing growth in the US, China, and the UK, with the key cities being New York, Los Angeles, London, Beijing, and Shanghai. Nike is focusing even more on its top selling cities. These big cities often set the trend, so doing well there can help the brand grow around the world. But there is a lot of competition, and winning back customers in China will take more than just opening stores. They need to connect better with local shoppers and earn their trust. Inventory management. The efforts are underway to right size inventory, particularly in classic footwear, to make room for new innovations. Right now, it's critical for Nike to clear out old products. Having too much unsold stuff costs money and forces them to lower prices, which hurts the profits. The big question is, can Nike move quickly from selling old items on sale to offering new full-priced products without losing their loyal customers? Sentiment and future direction. Sentiment here, the tone of the call was cautiously optimistic, with a focus on strategic execution and long term growth despite current headwinds. The management is aware of the challenges and is choosing to frame this as a transformational period. This is encouraging, but sentiment alone isn't enough. Investors need to watch for data backed progress in upcoming quarters, especially around margin recovery and inventory normalization. Future direction. Nike is committed to drive growth through innovation, brand storytelling, and an integrated marketplace approach. This aligns with how modern consumers engage with brands. The brand storytelling piece could help Nike differentiate itself in a saturated market, but again, it comes down to execution. Competitors like Adidas is stepping up their own storytelling too. Investment recommendation here is hold. Given the current challenges and the strategic shifts, a hold rating is recommended. Investors should monitor the execution of the win now strategy and the improvements in gross margins. This hold recommendation makes sense right now. Nike is clearly in transition, and while the long term brand equity is intact, the near term picture is cloudy. It's too early to buy aggressively, but too soon to sell if you believe in the recovery plan. The areas of concerns. This is continued revenue declines, particularly in China, and the impact of inventory liquidation on margins are key areas to watch. China will be a key test. If Nike can stabilize that region while maintaining discipline on pricing and promotions, it would validate the win now strategy. But if these declines continue, especially paired with aggressive discounting, it could signal deeper brand challenges. Potential upsides: successful execution of new product launches and marketplace repositioning could drive future growth. Nike's best chance right now is to focus on new product ideas and selling through the right channels. If their new products become popular and they can get more people to buy at a full price online, things could turn around fast. Even a small improvement in the profits could help the stock go up. Come to the conclusion, Nike is in a transitional phase, focusing on strategy, priorities to reignite the growth, while challenges remain, particularly in inventory management, geographic performance. The company's commitment to innovation and brand strength provides the foundation for potential recovery. The fundamentals are under pressure, but Nike is far from broken. This is still one of the most valuable and recognizable brands globally. The big question is whether they can adjust quickly enough to regain their edge before competitors fully capitalize on their current weakness. Until then, it's a watch and wait situation with eyes on execution. So overall, Lululemon's earnings look strong and steady, while Nike still has a chance to recover, but it needs to show more progress first. This is a takeaway from their most recent earning calls. Now let's look at their performance trend in a little bit longer time period over the past 2 years, which is 8 quarters. We'll look at the head-to-head comparison of their financial ratios on the profitability and see which company is turning their revenue into profit more efficiently. Let's start with the net profit margin, which tells us how much the actual profit a company can keep after all expenses. Over the last 8 quarters, Lululemon's average net profit margin was about 16.1%, while Nike's average just 10.1%. In the most recent quarter, Lulu hit 20.7%, while Nike fell to 7%. This isn't just a slight lead. Lululemon's is nearly tripling Nike's margin right now. That tells us Lululemon is far more effective at controlling costs and scaling earnings. Next up, gross profit margin. That's a key indicator of pricing power and the cost of goods sold. Lulu maintained a consistent gross margin about 57%, peaking at 60.4% last quarter. In contrast, Nike hovered around the mid-40s, dropping to 41.5% recently. That gap is massive. Lulu's ability to keep gross margin this high suggests the strong brand pricing power and highly efficient supply chain management, whereas Nike may be feeling the squeeze from the promotions and rising costs. Now let's look at their operating profit margin. That's a measure of the efficiency after operating expenses. Lulu averaged 22.3% and with a peak at 28.9% in the latest quarter. Nike, on the other hand, averaged around 10.7% and recently dropped to just over 7%. Lulu's operating machine is clearly running more efficiently. Now let's zoom out to broader efficiency metrics. Return on assets, Lulu averaged 6.2% versus Nike's 3.5%. Return on equity, Lulu came in 10.4% versus Nike at 8.2%. Return on capital employed, Lulu averaged 11.3%. That's nearly double Nike's 4.8%. So these return metrics tells us how well each company uses its resources such as assets, equity, and capital to generate profits. Across the board, Lulu is simply more efficient. So what does all this mean for investors? If you are in it for long term, Lulu's ability to consistently generate a higher profit margin and returns on capital makes it a standout in this sector. If you are looking short term, Lulu's most recent quarter with 60% gross margin and nearly 29% operating margin shows it's still executing at a high level. Nike remains a legendary brand, that's no doubt, but Lululemon is outperforming from profitability standpoint by a wide margin. Now let's look at their valuation, which is their fair price relative to earnings, growth, or book value. Because the profitability tells you how much the company can make money, but as an investor, the valuation tells you what you are paying for. Even a company is very profitable, it may be still a bad investment if you are overpaying. Let's start with their price to book ratio. This is a measure of how much investors are paying for a company's net assets. Lulu's price to book ratio fell from 14.7 to 11.44. That's a 22% drop. That's a sign of potential undervalued pricing relative to the company's book value. Now let's compare that to Nike. Its price to book ratio plummeted from 11.5 to just 3.1. That's a massive drop and it could mean one of two things. Too much undervaluation or the market is pricing in big risk. So my takeaway is that Lululemon decrease is healthy and gradual. Nike, on the other hand, its sharp decline raises questions. Now let's look at their enterprise value multiples, which show that what the market is paying for a company relative to its earnings. Lulu's enterprise value multiple dropped from 101 to 42. That's a 58% reduction, which could reflect better efficiency or a reset in market expectations. But Nike's enterprise value multiple, it jumped off the charts to 265 last quarter. That's a huge spike and could be a red flag for short-term overvaluation or excessive market optimism. This indicates that Lulu is moving toward a more fair valuation. Nike may be overpriced at current levels. The P/E ratio tells how much investors are paying for each dollar of earning. Lulu's P/E ratio dropped from 42.2 to 16.7. That's a 60% decline. Lower P/E ratio with strong earning growth, that's a compelling buying opportunity. Nike P/E ratio moved up to 37.2. That's more than double of Lulu's, even as Nike struggles with revenue and margin pressure. So from this, Lulu looks significantly more attractive here. Better earnings at cheaper multiple. Lulu's price to sales ratio has come down from 24.5 to 13.8, while Nike has hovered around 10.5. Yes, Nike looks cheaper here, but remember, Lulu delivers much higher margins and profitability, which justifies a higher sales multiple. A higher price to sales ratio for Lulu is not necessarily expensive if it's backed up by superior margins, which is true for Lululemon's case. Lulu's PEG ratio has stayed modest, even turning negative, showing earnings growth isn't being overpriced. Nike's PEG ratio spiked to 2.2 from 2.2 to 2.8 recently, meaning the higher valuation with less growth. So, what is the takeaway? Long term, Lulu's valuation has become more attractive. Nike, on the other hand, shows the potential overvaluation signs. Short term, Lulu is still worth watching. Is the price to book just ticked up, which could signal market optimism or volatility ahead. But overall, it's far more reasonable valued than Nike right now. Now, since Lululemon is obviously winning over Nike, let's also look at Lulu's price chart and see its latest technical setup. Lulu's stock price collapsed in early April, gapping down from around 320 to below 290 in a single session. This wasn't just a dip, it was a breakaway gap, which indicates serious institutional selling. It then flushed down to 240. That's a critical support level where it's now trying to base. Before the drop, Lulu was riding high up 43% from late October last year to December, peaking above 430. But since January it's making lower highs and lower lows. That's a textbook downtrend. Now we are seeing consolidation between 240 and 265. If both can break above 265, there is a shot at a short-term rally. But if it loses 240, watch out. The next support zone doesn't show up until the 220s or even 200s. Now let's run AI insights of some technical indicators. Let's use the popular indicator RSI to check it out. Okay, the short-term price trend, the recent RSI value such as 35.5 on April 11th, 2025 indicate a potential recovery from oversold condition. The RSI dipped below 30 on multiple occasions, notably at 24.26 on April 8th, 2025. That suggests oversold condition and potential for upward movement. The long-term price trend, the 200-day moving average of 337 on April 11th is above the current closing price of 261. This indicates a bearish long-term trend. The 50-day moving average of 339 and the 20-day moving average 297 also exceed the current price, reinforcing the bearish outlook. Let's see any bullish signal. The weekly bullish candlestick pattern such as the hive wave candle and a spinning top, this suggests the potential upward reversal. These patterns combined with the RSI recovery from the oversold levels indicate a possible short-term bullish momentum. What about a bearish signal? The daily Heki pattern is bearish, suggests the potential downward pressure. Additionally, the price remains below all the moving averages. This is the big red flag indicating the sustained bearish momentum. On the potential concerns, the RSI has shown the signs of bullish divergence with higher lows in RSI while price make lower lows. This suggests a weakening bearish momentum. However, the price position below the key moving averages and the presence of the bearish candlestick patterns indicate the caution. What's the investment recommendation? Given all the mixed signals, investors should exercise with caution. The short-term potential for recovery exists, but the long-term bearish trends suggest waiting for stronger confirmation of reversal, such as the price move above the 50-day moving average or the sustained RSI above 50 level. Lululemon is clearly outperforming Nike in profitability and operational efficiency, with stronger margins, better returns, and a valuation matrix. While the recent pullback has raised eyebrows, the numbers suggest that Lulu could be a compelling opportunity, especially for long-term investors. Nike still has its strengths, no doubt, but if you are looking for efficiency, growth, and a potential upside, Lulu is the one to watch right now. Of course, even Lulu stock is compelling, but its technicals still show some caution. So don't ignore the chart setup. Use tools like AlphaStock AI to track those signals in real time. If you find this analysis helpful, make sure to like, subscribe, and leave a comment below. Tell me, are you leaning on Lululemon or Nike in your portfolio? And if you want even more comprehensive analysis, head over to alphastockai.com, your edge in smarter investing. Thanks for watching. I will see you next one.